Do the regulations address the time frame in which a participant's elective deferral must be sent to the vendor?
Well, this is a very, very good point, and thank goodness they do, because we had a very strange rule in the past that generated a great number of phone calls from irate participants to me over the years that I've worked in 403B. And what happens essentially here is that an employee has their salary reduced January, February, March. Strangely enough, though, the employer does not forward these monies on to the funding organization, the vendor, the organization that offers the annuity or custodial account until, let's say, the end of that year, sometime in December. Well, people would call and they'd be very, very upset that why do these organizations have my money that I have reduced from my salary and they're not forwarding it on? Well, at the very least, I'm losing earnings, time value of money, etc. Well, that was a bit of a problem, and that was old revenue ruling 67-69, which basically said, believe it or not, that in order to have a good 403B, you only have to pass these amounts on to the vendor, but once a year. Well, that was pretty absurd. So we came up with a rule and an example that amounts have to be passed on to the vendor in an administratively feasible period, which we consider within 15 days following the month in which these amounts would have been paid to the participant. So what we like to call the 15-day example, but as with most things in regulations, examples take on more meaning than what they actually are examples and become, in most instances, the rule itself. So we have this 15-day provision, and it's very, very important to point out that if an organization, non-governmental, for example, which is subject to ERISA, they, even though we have this 15-day example, they must meet the much, much tighter rules of ERISA, which require amounts to be forwarded on to the vendor in a much, much tighter time frame. If you are subject to ERISA, you must abide by the ERISA time frame of forwarding amounts on to the vending organization. But if you're not, you will come under this new example, and also the fact that it must be done in an administratively feasible, as rapid as possible method to get the funds to the participant. So this cuts down the open-endedness of that old Rev Rule 67-69.
Bob, let's continue with these regulatory highlights.
Absolutely, Bernice. One of the regulation highlights states that there can be no more separate contracts of incidental life insurance with 403B.
What do you mean by separate contracts?
Well, 403B, much like a qualified plan, had for many, many years, and the Internal Revenue Service said this was okay, been entitled to use life insurance as part of the 403B equation within the limitations provided for incidental life insurance that a qualified plan would experience. For example, a qualified plan can put 25% of their benefits into a term life policy, and this was permitted with 403B. And what I mean separate contracts is you had, for example, an individual participant with a $100,000 accrued benefit in their 403B. He or she could take, and I'm going to use the term life as an example, which is 25% of your accrued benefit. He or she could take $25,000 and go out somewhere in cyberspace, for example, not even necessarily to the organization that funds their 403B, and make a one-time premium payment of the $25,000 to purchase whatever that amount would purchase in term life insurance. That was a separate contract of life insurance. In working on the regulations, we early on realized that 403B investments can be made only in annuities of insurance companies and in stock of a regulated investment company, a mutual fund. We didn't see where there was any room for separate contracts of incidental life insurance, even though past experience with the Internal Revenue Service said that was permissible. And as I mentioned earlier when we talked about grandfathering, those contracts issued up to 60 days after the date of the publication of the regulations, well, they're grandfathered. They're not going to be touched. They remain out there. But instances where you in the future want to take an accrued benefit percentage of your 403B, purchase incidental insurance, whether it's term, whole life, etc., that would not be permissible. But it's important to note that when we talk about separate contracts of life insurance not working any longer after the effective date of the regulations with 403B, we by no means attempt to say that you can't have incidental benefits within that annuity itself. For example, it's common that an annuity may have a death benefit. It may have a joint and survivor benefit. It may even have a disability benefit. As long as that benefit is incidental to the primary purpose of the annuity, which is retirement, you could have something like that as part and parcel of your annuity contract. That is not considered a separate contract of life insurance. So that still remains, and that's discussed in quite detail in the regulations.
Can you discuss planned termination for 403Bs?
Well, yes, and this is very, very interesting because 401ks have always been permitted to terminate, that is, distribute all the assets in an administratively feasible period, and the individuals to whom the assets were distributed could have the right to roll over or even a direct rollover. And governmental 457B plans also permitted, if the plan were to terminate, individuals could receive their distribution, in other words, a distributable event, as it was with 401k, and roll those amounts over to an IRA or other retirement plan to continue to maintain them in a tax-favored environment. The only program that didn't have this in regard to these other deferral programs was 403B. And remember, oftentimes these could be operated on the same platform. This is one instance where the distinction has been removed, and now in accordance with the regulations, 403B can also be terminated, very much in the same manner as a 401k can be terminated, and the individuals who receive their funds have the right to roll these over to other retirement programs, individual retirement accounts, etc. So this is a brand new ability for 403B to make distributions when a plan is terminated under the appropriate circumstances as outlined in the regulation.
Bob, I understand that severance from employment is one of the distributable events for receiving a distribution from a 403B plan. Do the regulations address severance?
Yes, they do. For example, if we were dealing with a situation where an individual did not any longer work for an eligible employer, they would be considered to have severed from employment. For example, let's assume someone participated in a 403B with a 501c3 organization, but for whatever the reason, that organization lost its 501c3 status and was considered not to be that type of a tax-exempt organization. But the individual who had the 403B continued to work for them. Then he or she would experience a severance from employment for purposes of receiving a distribution from their 403B.